Today, I'm going to walk you through how to analyze a real estate investment deal from start to finish so you'll never have to guess if this property is going to make you money or not. We're going to talk about things like appreciation, cash flow, risk tolerance, and things like ROI or your return on investment. By the end of this video, I promise you'll know how to analyze any deal that you want to do. I'm going to break this down into 6 simple steps so that way you'll never get confused. So the very first thing in step 1 that you want to do is you want to define your investment criteria. This is where you want to go over things like the type of property, location, budget range, and financing options, your desired returns, your risk tolerance. All this is super important. So let's break down each of those. With the type of property that you could potentially get, most of us who are beginners starting off from scratch, we're not trying to get into something that is too complicated. We're looking either for a single family home, maybe a townhome, but we're definitely staying away from condos. Those are terrible. And if you're potentially lucky enough to be looking for your first house, then you could do something that's called house hacking. There are tons of videos on this all over the internet. I've even got a couple of them. And essentially all you're doing is you're buying a duplex, a triplex, or a fourplex. You're gonna live in one side and rent out the others. Another huge thing is location. I will always say this in almost all of my videos, location matters so much. Because if you're not buying a property that's got good schools or it's got a good neighborhood, it appreciates in value really well, the renting situations are good. If these things aren't in the location you're trying to buy in, then it doesn't matter what you buy, it's not gonna be profitable. If you happen to live in a city that is declining, maybe a lot of people are moving away from, or it's just not growing, there's no real economy, there's no real big business, then it probably isn't the best situation for you. Oh yes, I can hear all the comments now, but my city is great. I've bought in a city that, has terrible location, but I still make money. Yes, in every location, there's gonna be some good ones, but as a whole, your city could not be that good. Another part of your criteria has to be your budget range. And going right along with that is your financing options. Now, I just did a video, it's step 1 to this whole series. It's how do you actually find money? Because nothing really matters if you don't have the money to actually buy these properties. So if you're not sure about how to get financing, I'll leave a link down in the description so you can go watch that video. But finding the money is very important, and knowing how much money you have to work with is even more important. So in this first step, you're gonna make sure that you have your financing done, you've gotten pre-approved, you got cash set aside. However you're gonna fund these properties, you need to make sure that is in place. The next part of this is going to be figuring out what do you want out of this property? What are your desired returns? There's a few terms that we're going to cover later on in this video, like your cash on cash return, your cap rate, your NOI or net operating income. These are things that you're going to want to sit down and say, what do I need from my rental property? Do I need to bring in some more money? Do I need positive cash flow? Or do I really just need this for tax purposes? Because some of us have really, really good jobs and we need these properties for tax write-offs. So going into these properties, knowing exactly which way you need to go is huge. And lastly, you need to know your risk tolerance. If you know you're someone who has a really high risk tolerance, you're willing to gamble everything on one single property, that's good. But if you're someone who's a lot less risk tolerant, if you don't like to do that, if you want to be very, very careful, very strategic, that's important because that is going to tell you what type of property you will or will not go after. And just to help you out some more on that, if you're not a really high risk tolerance person, you might want to go with something that's more turnkey, that probably already has a renter in it, because you'll know immediately it'll cash flow, because a lender won't lend if it's not cash flowing. Step 2 is where you want to start gathering all the data from these properties. And we're gonna go over some calculations in step 3 to really nail down and decide how do you figure out what's good or not. But let me give you some terms first. Things you wanna know is you wanna know like your asking price, you wanna know the expected purchase price, rental income, property taxes, insurance, HOA, all the maintenance, the different types of loan terms. All these things are a group of terms that we're gonna go over and we're gonna talk about so you really understand what all of it means. So starting with the asking price and expected purchase price, that's pretty simple. It's what is the seller asking for the property and what do I think that I can get the property for based on the comps that I've run. Now, if the seller has done their homework, they're probably not gonna ask more than it's really worth, or they might ask a little bit above, knowing that someone's gonna give closing costs at the closing. but usually you should be pretty close. Another big, huge part of information you really need to do your research on is rental income. If you're buying a piece of property that has a tenant already in it, you need to know, is this actually market rent or can I raise the rent? Because if you're not getting market rent for that property and you need to increase it, you need to know how much time left is on the current lease before I can raise it. And that is also going to be a huge factor when you're getting a loan, because the lender is going to know the exact same thing that you know. Another big part of data that you need to grab before we even purchase this property is you're going to have to figure out property taxes, insurance, and HOA fees. Now, a lot of this is going to be very easy to find. You're going to have your websites that show you how much taxes are for every single property in your city. Insurance should be pretty simple. You can get quotes, or you can just call the seller directly, say, hey, how much is your insurance? And then HOA fees are very important to know. That can make or break any rental property. Now we need to go ahead and gather what are called our operating expenses. These are going to be things like your maintenance, your property management costs, utilities costs, things like that. Knowing an estimate on how much all that is before you buy a property is so important, because if you don't account for it, when it comes time to pay that, you won't have planned for it and you won't have the money. And lastly, you need to be able to know what this loan is going to look like, what's your interest rate, your monthly payments. You need to know, do you have an adjustable rate mortgage? Do you have a fixed, which fixed is always better? Or you need to know, are you going to have an interest only payment, which you shouldn't do if you're doing long term. Okay, so now we're going to move on to step 3. And what I'm going to do is I'm actually going to show you a actual spreadsheet on a property that I've personally done and walk you through how to calculate any of this to see if it's good. I have 2 sets of numbers. I have a projected set of numbers, and then I have the actual set of numbers, and I'll walk you through everything and show you how to calculate it. Okay, so let's look at these numbers and let me walk you through it. Okay, so as you can see, I have at the top a projected renovation budget, and I have things broken down into material and labor as well as total. Now, these are gonna be quotes and estimates and things that I've gotten. I've been doing this a while, so I kind of know what things cost based on what projects I've done in the past. But as you can see, I have things broken down from paint, cabinets, flooring, countertops, HVAC, windows, even cleaning, utilities, any permits. You need to know every single piece of information that you can before you buy it. And as you can see on the far left, I have a projected investor analysis. How much is this house gonna cost me to fully renovate? That's including the purchase price, the renovation, if there's any commission involved. Usually if I'm buying something off market, there is no commission. If there's any insurance costs, what is that gonna look like? Holding costs and utilities. I personally use lines of credit to purchase properties, so that interest counts. And then I have a total expenses, potential net proceed, as well as the percentage. Now, any percentage that is 20 to 25% is gonna be something you hold on to. Anything less than that is gonna be something you wanna sell. Now, as you can see down below, I was actually about $10,000 under on the actual renovation budget, which is good because that extra $10,000 I usually have as a reserve just in case something goes wrong. And as you can see under the actual analysis, I was about 2% over my projected proceeds, which is fantastic. Okay, so based on all these numbers that I just shown you, let's calculate some of the key pieces of information to analyze this deal. The very first thing we want to start with is what's called the gross rental income. So in this case, I was able to get this thing rented out for $19.75 per month. And this number you want to multiply by 12 to get a yearly number, which in this case is $23,700. The next number you want to get is what's called your operating expenses. That's going to include things like your taxes, your insurance, your mortgage payment, any property management that you may pay. You also want to allow for a 5 to 10% vacancy allowance and any HOA fees if necessary. For me, I know that my monthly payment, including my mortgage, my insurance, and my taxes, is going to be right under $1,500. Or that's also $18,000 per year. The next thing we want to move on to is called the net operating income, or NOI for short. All this simply is taking that first number of the gross rental income and subtracting your operational expenses. So in this case, that's $23,700 minus $18,000, which means I'm left over with $5,700. But we don't stop there because there's a few more calculations we need to do to see if this is a good property. Next thing we want to do is we want to calculate what's called the cap or the capitalization rate. All you want to do is take your NOI or your net operating income number, divide that by the purchase price, and then multiply it by 100. So in this case, my NOI is $5,700, and for me, my purchase price, you can go ahead and use the $90,000 that you purchased it, but remember, we did have renovation costs. But for now, let's just use that purchase price. So $5,700 divided by 90,000, and then you multiply it by 100, we get a cap rate of 6.33%. And yes, that is really good because usually anywhere between 5 and 8% is going to be a good solid standard. Now, yes, this cap rate can vary by market, so definitely check with your local area, doing a quick Google search, seeing what is a good cap rate for my area. Now, let's run that same calculation, looking at it from the standpoint of I purchased the property and I also had to make renovations. So all in, I was a little over $201,000 all into this property. So if we take that $5,700 and divide it by the $201,000 that I spent to purchase and rehab the property, and then you multiply that by 100, you get a cap rate of 2.84%. And now I know that is lower than what we talked about, but here's the thing. I used a line of credit to purchase this property and to rehab. So I have absolutely $0 of my own money into this deal. Sure, there was interest costs and things like that I had to pay for that was very minimal, but because I have this line of credit tied to a high yield savings account that is making some extra money, I'm able to offset this, and easily this is a great deal because I have no money into it. So at the end of the day, I bought a property, it's got equity, it's cash flowing, and I didn't use my own money. That is always a win, no matter what anyone says. So the final calculation that we need to run and something we need to talk about is what's called a cash on cash return. So this is going to figure out how much of a percentage the cash that you put into the deal is making by buying this property. Now remember, I have no money into this current deal, but this is what you would do to figure out if it's a good deal. So this cash on cash formula is pretty simple. What you want to do is you want to take your annual cash flow and you want to divide it by your initial cash investment and then multiply that by 100. So for argument's sake, let's say that the cash that I used to purchase and renovate the property is my initial cash investment. So the annual cash flow is $5,700. Divide that by the $201,000 that we put into it and multiply that by 100, and you'll see that it is very similar to the cap rate. And with this cash on cash return of almost 3%, this is a pretty solid deal, although it could be a little bit better if you were all in with your own cash. So now in step 4, what you want to do is assess the potential appreciation for your property. Using some free resources like Zillow and Redfin can actually be very helpful. They're going to give you a lot of historical trends about the market. They're going to tell you what properties have been doing over the past year, 5 years, 10 years, and from there you can gather some data and determine over the next 10 years, how much is my house going to actually appreciate? Another huge thing you really need to consider is you need to consider the economic factors in that city. This is so important when considering buying because this is going to tell you the future of that city. If you know that a lot of big businesses are currently in your market, but they're thinking or getting ready to leave, the numbers right now might look really, really good, but in 5 years, they could look absolutely horrible. Also, taking the time to research what is your city trying to do to improve itself. Is the local government spending money to redo infrastructure, to improve roads? Are they giving money to new businesses? Are new schools being formed? All of this is huge for a city's long-term growth and directly affects real estate. And the last part that you really want to look at is you want to look at comparable sales in that area for your property. I personally like to stick within a 1 mile radius of that house, but sometimes it does require you to go out a little further to find good comps. I also personally do not like going back further than a year because anything later than that is not going to be really a good comp that most appraisers are going to use. Taking the time to research other properties that have been renovated that are going to be in the same condition as your property when you go to rent it is massive. Also, try not to mix and match houses. So for example, if you have a 3-bed, 2-bath, 1,500 square foot, don't try to compare it to a 4-bed, 3-bathroom that's 2,500 square feet in a way better neighborhood. Try to stick to parameters that are really close to what you own. Step number 5 is going to be identifying any and all risks that come along with this potential property. One of the biggest things that you could make a mistake on is overestimating your rental income, or on the flip side, underestimating your expenses. If you happen to go out and buy a piece of property that is in a flood zone and you don't account for that flood insurance, that could easily destroy half of your cash flow every single month. Or if you go into this property thinking you're gonna get $2,500 in rent, and you actually in reality only get 2,000, that could be a huge deal, and you could easily over improve with the assumption that you're gonna get this amount of rent and you never get it. Take the property that I just showed you the numbers on. Everything worked out perfectly for me to get 1975, but what if I went into it assuming I was gonna get 2,500 and I never did? I could have over improved it. I could have made my monthly expenses really, really expensive, and at the end, it could have burned me. So doing your research on the finances is gonna be massively important. Another thing to take into consideration is this area that you're buying this property, does it have a high vacancy rate? I usually allow for 5 to 10% when I'm running my numbers, but if you know that this area is gonna have more than that, don't discount it, and I almost would stay away from it if it's higher than about 15%. Now, this next piece of advice is huge, and remember, I'm not giving you legal advice, so you should definitely look into it on your own, but having the right legal entities in place when purchasing property is big. Me personally, I have an LLC that I buy properties in, but there's so many different structures and ways to do it, and there's way better ways than just buying in your personal name. So consider looking up some advice, talking to some people who are professional lawyers, looking into the correct legal entities before buying. The last piece of risk that I want to tell you about has to do with mortgages, and specifically adjustable rate mortgages. You'll hear a lot of lenders sometimes say adjustable rate mortgages can be really, really good. You'll have a really low payment right now, and then they'll adjust with the times, but here's why you might want to stay away from those. No one is ever going to be able to predict the future and know exactly what rates are going to look like in 5 years. Now, yes, on some bigger commercial deals, it's standard practice, but when you buy a single family home, it's not. You can easily get a 30-year fixed on your single family resident, or even a duplex or a triplex or a fourplex. So don't let the lender convince you that it could be better. Okay, so step number 6 is the most important part, because now we have to take everything we've learned in the first 5 steps and have to ask ourselves one important question. Is this a good deal or not? Some of the key questions that you need to ask are, does the property meet or exceed your financial criteria? Is the neighborhood aligned with your goals? Have you accounted for all the risk? And does this property fit your long-term strategy? Looking at the example that I just showed you, for me, it fit everything that I wanted. I knew I could get good rent. I knew I could renovate the property and have a good amount of equity. I knew it wasn't gonna be that hard to find a tenant. It only took me about 3 months, which is solid because it's the winter time. Wintertime out here is a terrible time to rent, and it didn't take that long to refinance and pull the money back out. I knew that this neighborhood was good. It was close to schools. It was in the heart of my city where a lot of businesses are. So I knew it was a no-brainer. And for me, I like to buy and hold my properties, build up a single family portfolio, and then eventually, once you have enough, you can sell everything. 1031 tax exchange, which is a whole concept I'm gonna be teaching soon, and you could roll all of this money into a big complex and easily in the next 10, 15 years, have hundreds of units. So I wanna know from you guys down in the comments, if you're currently looking at a rental property, did you do any of these things that I mentioned up above? If so, leave a comment down below.